The following is MMFS's current economic update. This year has been a very inconsistent one for investors, and it's only half over. Although recent events in the United Kingdom have dominated recent headlines, it was not that long ago when the big global concerns were about Asia. It also seems like the free fall of oil prices and high contentious presidential primaries are distant memories. The second quarter of 2016 was a period where investors were reminded once again of the market's volatility. At the quarter's end, U.S. equities added 2.6% for the April to June period, as measured by the Russell 3000 index. Much of the biggest gains came from energy stocks, which benefited from a rebound in oil prices, and utilities and telecom companies, which became more attractive as bond yields declined. Non-U.S. equities lost 1.3%, as measured by Russell's ex-U.S. large cap index, and bonds grew 2.2%, as measured by the Barclays U.S. Aggregate Bond Index. Longer-term returns can be seen on the chart on your screen. As of the end of the second quarter, central banks appear ready to keep rates lower for longer. So far in the United States, there's been only one rate hike since the end of the Great Recession. It was December when the Fed increased rates from near zero to a range of 0.25 to 0.5%. This year, there have been no rate increases, and Fed Chair Janet Yellen has already signaled a reluctance to raise rates. Yellen told Congress on Tuesday, June 21st, that weak economic growth in the United States could force the Federal Reserve to hold off on any imminent interest rate increases. Proceeding cautiously and raising the federal funds rate will allow us to keep the monetary support to economic growth in place while we assess whether growth is returning to a moderate pace, she said. MFS chief economist James Swanson provided this chart showing his checklist of issues that they monitor when determining if a recession is likely in our near future. The chart shows that the only area that is recessionary is the falling profits of U.S. corporations as it relates to the share of GDP. Since the global financial crisis of 2008, major central banks have implemented extraordinary monetary policies. This has included reducing interest rates to a near zero rate. Central banks use this strategy to promote growth and provide economic stimulus. We believe that investors always need to consider the risks of investing when making decisions. Investors should always be prepared. A well-defined investment plan tailored to your goals and financial situation that considers the chance of normal ups and downs in the market can help investors during volatile times. No one can fully predict the future, and past performance is no assurance of any type of financial return. Investors do have historical information to review, however. In fact, what seemed like some of the worst times to get into the market turned out to be the best times. As the chart shows, the best 5-year return in the U.S. stock market began in 1932 in May, in the midst of the Great Depression. The next best 5-year period began in July 1982 amid an economy in the midst of one of the worst recessions in the post-war period, featuring double-digit levels of unemployment and interest rates. Other good 5-year periods include the one following the 2009 Great Recession. Today's low interest rates are not helping investors and retirees who might need current income. Pension funds and insurance companies are also facing difficulties in generating returns that meet their needs. At the mid-year roundtable conducted by Barron's, a panel of stock market experts felt that stocks would rise by less than 5% in the second half of 2016. Although they predict a rise, they cautioned investors to be very selective when choosing investments. At MFS, we believe the U.S. stock market returns will average approximately 7% per year over the next several years, certainly shy of the long-term historical 10% plus average annual returns of the S&P 500 index. As always, investors need to proceed with caution. We are constantly reviewing our investment models based on actual data we receive to optimize your portfolio based on return and standard deviation. We are carefully monitoring equity markets and interest rates so we can communicate with clients. Experts are predicting that the second half of 2016 could include uncertainty, which typically causes quick and extreme volatility. Market volatility is a part of investing, so instead of being worried by volatility, be prepared. So what have we been doing at MFS recently? In general, we have been allowing cash to accumulate in most portfolios, as well as modestly reducing risk by rebalancing into slightly less volatile asset classes. We still have confidence in the market, although our comfort for risk has dropped slightly as the market values have increased to higher than average valuations. We are looking for other opportunities to invest, which may take some time. Thank you for listening. If you have any questions at all, please call our office at any time. Thank you.